Hi everyone, so I'm here with Darren Joseph today, who is a specialist in expat taxation matters. I'm Adam Fayed, I run adamfayed.com, and we are an expat wealth management organization with clients in over 109 different countries.
Adam, it is an honor and a privilege to be speaking with you. My name is Darren Joseph from HTJ.tax. We're a team that seeks to demystify the sometimes confusing world of international tax. So we work with expats, location-independent entrepreneurs, nomads, so described, anyone basically who would describe themselves as a private client exposed to more than one jurisdiction.
Another thing is, obviously, there are those territorial tax country systems. Now, I know a lot of them are changing now. Thailand is changing, a few are changing. But nevertheless, even though each territorial tax system is different, just because overseas income isn't taxed, that usually means passive overseas income, right? In the vast majority of cases, it doesn't mean if you have a physical office in, say, Singapore and you're working 70 hours a week from your home office. Usually, in most of those places, it creates a permanent establishment, right? So territorial tax in the vast majority of cases means if you're like, I don't know, you sold your company and you got passive dividends, or like you're a pensioner or whatever. But when you have a business, which is an active vehicle, often it doesn't have the same meaning, right? I think that's another big misconception that you see out there.
Absolutely. You're absolutely correct. That is a huge misconception. Again, peddled by some pretty well-known influencers. The idea that territorial tax means that you can just sit there and enjoy certain benefits. And generally speaking, when we say territorial, we mean passive or so-called unearned income. But right now, even with passive income that was generated outside of the territorial tax jurisdiction, it can still be taxed upon remittance into the territorial tax jurisdiction. And there have been some recent changes in the law. And again, sticking to Asia because that's where I'm primarily based. So I'm thinking Singapore, Malaysia, and Hong Kong. Under certain circumstances, dividends or even capital gains that arise outside of the jurisdiction, even though these are territorial tax jurisdictions, upon remittance into the territory, it could, under certain circumstances, be taxable. So again, tax is very nuanced, and there's a reason why you have these whole teams. No one person knows every aspect of a given jurisdiction, and one must be careful about where one gets advice.